The 2008 economic collapse marked a pivotal moment in global finance, leading to widespread repercussions that affected economies around the world. This crisis, rooted in the housing market's collapse, triggered a domino effect that resulted in massive bank failures, unemployment spikes, and a loss of consumer confidence. Among the key players in this tumultuous period was American International Group, AIG, whose controversial role has been scrutinized extensively. As one of the largest insurance companies, AIG was deeply intertwined with the financial sector, particularly through its involvement in complex financial instruments. The company's issuance of credit default swaps, CDS, became a focal point of the crisis, as these derivatives were intended to provide insurance against defaults, but ultimately contributed to systemic risk. AIG's precarious position not only highlighted the vulnerabilities within the financial system, but also raised questions about regulatory oversight and corporate responsibility. This discussion sets the stage for a deeper exploration of the intricate financial mechanisms that played a significant role in the 2008 collapse and AIG's involvement in this unfolding drama. In the late 1990s, American banks experienced a significant influx of foreign funds, which contributed to an environment of easy credit and aggressive lending practices. This surge in capital availability led to the rise of subprime mortgages, targeting borrowers with poor credit histories who were often unable to secure traditional loans. These subprime mortgages, while initially appealing due to their low introductory rates, carried high risks for borrowers, resulting in increased default rates as interest rates rose and housing prices began to decline. To manage the perceived risk associated with these loans, banks developed complex financial products known as collateralized debt obligations, CDOs. By bundling together various mortgages, including subprime loans, into these securities, banks aimed to spread risk and create seemingly safer investment opportunities. However, this practice obscured the true risk levels and ultimately contributed to the financial system's instability. As defaults mounted and housing prices plummeted, the interconnectedness of these financial instruments revealed the fragility of the banking system, setting the stage for the catastrophic events of the 2008 financial crisis. American International Group, AIG, stood as the largest insurance company in the United States, boasting a significant global presence that extended across various financial markets. In the years leading up to the 2008 financial collapse, AIG adopted a strategy focused on selling credit default swaps, CDS, which were designed to provide insurance against the default of various financial instruments, particularly mortgage-backed securities. This approach was intended to mitigate risks associated with the growing number of subprime mortgages and the volatile housing market. AIG's financial products division experienced rapid growth during this period, capitalizing on the demand for these derivatives as investors sought ways to hedge against potential losses. However, this expansion came with increasing exposure to risk as the division became heavily involved in the very financial instruments that would later contribute to the crisis. The allure of high profits and the perceived safety of CDS masked the underlying vulnerabilities, ultimately placing AIG at the center of the financial turmoil that unfolded, leading to its near collapse and subsequent government bailout. Credit default swaps, CDS, played a crucial role in transforming risky collateralized debt obligations, CDOs, into seemingly safe investments, allowing investors to believe they were insulated from potential defaults. By purchasing CDS, investors could transfer the risk of default to AIG, which promised to compensate them in the event of a borrower failing to meet their obligations. This mechanism created a false sense of security, as the perceived safety of these investments was largely based on statistical probabilities rather than actual geocapital reserves. AIG, in its eagerness to capitalize on the booming market for these derivatives, significantly underestimated the risks involved, leading to an overexposure to CDS. This reliance on models and assumptions about default rates failed to account for the reality of the housing market's decline, resulting in catastrophic losses when defaults surged. As the financial crisis unfolded, AIG's inability to cover its obligations under the CDS contracts not only jeopardized its own stability, but also threatened the broader financial system, highlighting the dangers of excessive risk-taking in the pursuit of profit. The timeline leading to AIG's financial downfall began with the housing market crash in 2007, which had a devastating impact on subprime mortgages. As housing prices plummeted, many borrowers defaulted on their loans, leading to significant losses for financial institutions holding these risky assets. AIG, heavily invested in credit default swaps, CDS, tied to these subprime mortgages, found itself unable to meet its obligations as defaults surged. This inability to pay out on CDS contracts not only threatened AIG's stability, but also triggered a broader crisis, as counterparties began to panic over the potential ripple effects throughout the financial system. The rapid sequence of events escalated quickly. By September 2008, AIG's stock plummeted and its credit rating was downgraded, prompting fears of insolvency. In a desperate bid to prevent a complete collapse, the US government intervened, ultimately providing an $85 billion bailout to stabilize the company. This intervention underscored the interconnectedness of financial institutions and the systemic risks posed by AIG's extensive involvement in the derivatives market. The government's response to AIG's impending collapse was heavily influenced by the concept of too big to fail, which posits that certain financial institutions are so integral to the economy that their failure would have catastrophic consequences. AIG's extensive connections to global financial markets and its role in ensuring various financial products made its collapse a significant concern for regulators. In September 2008, the Federal Reserve stepped in with an $85 billion bailout, providing liquidity to stabilize the company and prevent a broader financial crisis. As part of this intervention, the Federal Reserve took an equity stake in AIG, effectively becoming a major shareholder to ensure oversight and accountability. Following the bailout, significant changes in leadership and management were implemented to restore confidence and address the company's risk management practices. New executives were brought in to navigate the restructuring process, focusing on unwinding AIG's complex financial products and stabilizing its operations. This response highlighted the government's commitment to preventing systemic collapse, while also raising questions about moral hazard and the future of regulatory oversight in the financial sector. The aftermath of AIG's bailout was marked by significant financial losses, with the company reporting staggering deficits that reverberated through the stock market. Following the intervention, AIG's stock plummeted, reflecting investor skepticism about its future viability and the broader implications of the financial crisis. However, over time, the government's stake in AIG proved to be profitable. As the company restructured and stabilized its operations, it began to recover, allowing the government to gradually sell its shares, ultimately recouping a substantial portion of the bailout funds. Despite this financial turnaround, the long-term effects on AIG's operations and reputation were profound. The company faced ongoing scrutiny and criticism for its role in the crisis, leading to a shift in corporate governance and risk management practices. AIG implemented stricter oversight and a more conservative approach to its business model, aiming to rebuild trust with stakeholders. While the company eventually returned to profitability, the shadow of the bailout and its implications for regulatory reform lingered, forever altering the landscape of the financial industry and AIG's standing within it. In summary, the video highlights AIG's pivotal role in the 2008 economic collapse and the subsequent financial turmoil that ensued. As one of the largest insurance companies, AIG's involvement in credit default swaps and its overexposure to risky financial products significantly contributed to the crisis, leading to its dramatic bailout by the US government. The aftermath of this event not only reshaped AIG's operations, but also prompted widespread discussions about regulatory reforms and the concept of too big to fail. Viewers are encouraged to reflect on the critical lessons learned from this financial crisis, particularly regarding risk management and corporate responsibility in the financial sector. Understanding these lessons is essential for preventing similar occurrences in the future. If you found this video insightful, please consider subscribing, liking, and sharing it with others who may benefit from this information. Your support helps us continue to provide valuable content that explores the complexities of finance and its impact on our world.